Bitcoin surged past $92,000 this week, marking a 20% rebound from its April lows. This upward movement is attributed primarily to renewed institutional inflows and macroeconomic concerns surrounding the US dollar. According to finance magnates, the resurgence is not purely technical. Investors are reallocating funds into Bitcoin as a hedge against ongoing inflationary pressure and potential Federal Reserve policy shifts. Rising interest in Bitcoin ETFs is a notable factor, with Bloomberg ETF analyst Eric Balcones reporting over $12 billion in net inflows since early Q1 2025. Bitcoin's ascent coincides with a broader weakness in the US dollar and a plateauing interest rate environment. With traditional equities facing earnings compression and geopolitical risks weighing on fiat currencies, Bitcoin is reasserting its role as a store of value, frequently referred to as digital gold. Robert Kiyosaki, best known for Rich Dad Poor Dad, reiterated his bullish stance, predicting that Bitcoin could hit $180,000 to $200,000 by the end of 2025. He cites the diminishing purchasing power of the dollar and growing institutional demand as key catalysts for this projection. CoinShares analysts forecast Bitcoin could test the $110,000 level by Q3 2025, contingent on sustained ETF demand and continued macroeconomic volatility. Long-term investors remain optimistic due to Bitcoin's limited supply. Data from Glassnode reveals that over 70% of Bitcoin's circulating supply has not moved in the past 6 months, indicating robust holder conviction. For short-term traders, ETF inflows and interest rate commentary from the Federal Reserve will likely be primary catalysts. For longer-term investors, the narrative centers around scarcity, institutional adoption, and increasing recognition of Bitcoin as a hedge against systemic financial risk. Our short-term prediction summary: if ETF inflows remain consistent and macroeconomic conditions continue to favor alternative assets, Bitcoin could challenge the $100,000 level within the next 6 to 10 weeks. Increased volatility should be expected around Federal Reserve meetings and inflation data releases. Equifax reported Q1 2025 earnings that beat analyst expectations, propelling shares upward by nearly 14%. According to Reuters, revenue climbed 4% year-over-year. Adjusted earnings per share reached $1.53, surpassing the consensus estimate of $1.40. Notably, this performance occurred despite weakness in the mortgage segment. The company's Workforce Solutions unit delivered EBITDA margins exceeding 50%, a sign of operational resilience and strategic balance. Management reaffirmed full-year guidance, forecasting revenue between $5.91 billion and $6.03 billion and EPS between $7.25 and $7.65. This consistency signals confidence in the company's trajectory despite ongoing economic uncertainty. Additionally, Equifax announced a 28% dividend increase and a $3 billion share repurchase program, affirming a shareholder-friendly capital allocation strategy. CEO Mark Begor emphasized that Equifax stands to benefit from increased demand in income and identity verification services, particularly within government programs. He cited the reduction of improper federal payments, totaling over $160 billion, as a new growth vector. The company recently secured an extension on its contract with the Social Security Administration, further enhancing its public sector credibility. Wells Fargo responded to the earnings report by maintaining an overweight rating and raising its price target from $275 to $288. TipRanks shows an average analyst target of $281, implying 16% upside from current levels. Short-term momentum may be supported by the dividend announcement and buyback program, while long-term investors are likely to focus on Equifax's diversification and expanding government footprint. Our short-term prediction summary: Equifax's share price may continue to gain over the next quarter, potentially reaching the $265-275 range, fueled by strong guidance, dividend increases, and federal contract optimism. Pentair, a leading provider of water treatment and pool equipment, saw its shares rise by over 9% following a Q1 2025 earnings beat. According to Yahoo Finance, adjusted EPS came in at $1.11, exceeding the $1.01 consensus. While revenue declined slightly year-over-year, the company offset the drop through margin expansion and operational efficiencies. CEO John Stotch stated that the company's efforts in mitigating supply chain challenges and tariffs were successful. He highlighted that Pentair has delivered 9 consecutive quarters of organic growth. Importantly, 75% of Pentair's revenue is derived from non-cyclical, aftermarket, and break-fix segments, providing a defensive revenue base. RBC Capital raised its price target to $101, referring to the guidance reaffirmation as a de facto upward revision given current macroeconomic headwinds. Analysts on Wall Street's end project that the 12-month target remains in the upper $90s, with strong tailwinds expected from seasonal demand and infrastructure investment. For traders, short-term catalysts include summer seasonality and continued momentum in residential pool equipment sales. For long-term investors, Pentair's focus on smart water solutions, efficiency initiatives, and infrastructure exposure provides a compelling value proposition. Our short-term prediction summary: seasonal demand may push Pentair's stock price into the $88.92 range over the next 4 to 6 weeks, supported by a favorable earnings beat and summer-driven retail interest. First Solar experienced a sharp rally of more than 10.5% after the U.S. Department of Commerce imposed tariffs as high as 3,521% on solar panel imports from Southeast Asian countries. According to CNBC and Investopedia, these tariffs target companies allegedly circumventing existing duties by channeling Chinese solar products through regional affiliates. First Solar, which does not rely on Chinese supply chains, stands to benefit directly. The company operates multiple U.S.-based manufacturing facilities and employs cadmium telluride technology, avoiding the polysilicon bottlenecks that affect many competitors. This gives it a unique position to capitalize on domestic energy policies like the Inflation Reduction Act. CEO Mark Widmer has long advocated for fairer trade policies and emphasized in a Senate hearing that subsidized Chinese imports had distorted market dynamics. He pointed to First Solar's vertically integrated U.S. operations as a structural advantage in adapting to trade enforcement measures. Bank of America and Guggenheim both reiterated buy ratings following the tariff announcement, assigning price targets of $237 and $250, respectively. Analysts surveyed by the Wall Street Journal expect earnings growth of over 56% year-over-year, driven by long-term contract execution and new plant ramp-ups. Our short-term prediction summary: FSLR may extend its rally into the $210-$220 range in the coming 3 to 6 weeks as investors digest the full impact of import tariffs on competitors and renewed policy support. General Electric reported Q1 earnings that exceeded expectations. Revenue rose 8.8% year-over-year, backed by a $140 billion backlog in aerospace services. According to Bernstein, which raised its price target to $254, the performance was notable not just for the beat, but for the reaffirmation of full-year guidance. CEO Larry Culp highlighted that GE Aerospace is well-insulated from near-term macro headwinds. The company built in assumptions for as much as $500 million in potential tariff costs, ensuring guidance reflects conservative planning. Culp has called for a return to tariff-free trade in the aerospace industry, advocating for cost neutrality in global aviation markets. GE's long-term strategy includes investments in sustainable aviation technologies and next-generation jet engines. The company is streamlining operations post-divestiture and refocusing on innovation in high-margin sectors. TipRanks shows an average analyst price target of $240, with several institutions raising projections after Q1 results. For traders, the combination of earnings momentum and bullish analyst revisions presents an actionable setup. For long-term investors, GE's strong order pipeline, management credibility, and technological investments represent a durable growth thesis. Our short-term prediction summary: GE could rise toward the $200-$210 range within the next 6 to 8 weeks, fueled by bullish guidance, backlog strength, and sustained demand in the aerospace sector.